Welcome. If you're studying economics or finance, the bond market is one of the most important concepts you'll ever encounter. In this video we're going to cover all the essentials: what bonds are, how governments borrow, who buys bonds, key terms you need to know, and how the bond market connects to the wider economy. Let's get into it. So, what exactly is a bond? A bond is essentially a loan. When you buy a bond, you are lending money to the issuer, usually a government or a corporation. In return, the issuer promises to pay you regular interest, called the coupon, and to return your original money, the face value, on a set date called the maturity date. Simple as that: you lend, they pay interest, they pay you back. Now, why do governments issue bonds? Governments spend money on public services, healthcare, infrastructure, education, defense. Sometimes what they spend exceeds what they collect in taxes. That gap is called a budget deficit. To fund that deficit, governments borrow money by issuing bonds. Investors buy those bonds, the government gets cash today, and repays the debt over time. Think of it this way. Government spending is the tall bar on the left. Tax revenue is the shorter bar on the right. The gap between them, that's the deficit. And that deficit is filled by issuing bonds to investors. Before a government borrows, it relies on tax revenues. These come from income tax paid by workers, corporation tax paid by businesses, and indirect taxes like VAT. The level of tax revenue fluctuates with the economy. When growth is strong, revenues rise. When the economy slows, revenues fall. That's a key reason why deficits tend to grow during recessions. So who actually buys government bonds? The answer might surprise you. The biggest buyers are institutional investors, pension funds, insurance companies, and banks. Pension funds in particular love bonds because they provide predictable, stable income to match their long-term liabilities. Central banks also buy bonds as part of monetary policy. And individual investors can buy them too, though that's less common. Pension funds seeking stable returns. Banks and insurance companies managing risk. And central banks conducting monetary policy. These three groups dominate the bond market. Let's lock in the key terms. Face value, the original amount borrowed, repaid at maturity. Coupon, the regular interest payment you receive for holding the bond. And maturity, the date when the government repays your principal in full. A few more terms worth knowing. Gilts are UK government bonds. Treasury bonds are the equivalent in the United States. And a credit rating is the score assigned to a bond issuer reflecting how likely they are to repay. The higher the rating, the lower the risk, and typically the lower the interest rate. Now for one of the most important concepts in the bond market: yields. The yield on a bond is the return an investor earns relative to its current market price. Here's the key relationship: when bond prices rise, yields fall. When bond prices fall, yields rise. They move in opposite directions. This is fundamental, make sure you understand it. Why do yields matter so much? Because they are the interest rate the government must pay to borrow. When investors lose confidence in a government's ability to repay, perhaps due to high debt levels or political instability, they demand higher yields as compensation for risk. That pushes up the government's borrowing costs dramatically. You've probably seen this play out during sovereign debt crises. The bond market operates in two stages. In the primary market, bonds are issued directly by the government to investors for the first time. This is where the government raises its cash. In the secondary market, those bonds are then traded between investors. The government is no longer involved at this stage. Secondary market prices fluctuate constantly, and that's what drives yield movements. Governments rarely pay off their entire national debt. Instead, they roll it over. When an old bond matures and the government must repay the face value, it typically issues a new bond to raise the cash needed to make that repayment. This means the debt is continuously refinanced rather than eliminated. The risk here is refinancing risk. If market conditions deteriorate, rolling over the debt becomes much more expensive. Finally, how does the bond market affect the stock market? The connection is direct and important. When bond yields rise, bonds become more attractive relative to stocks. Investors can earn a solid return with much lower risk. This pulls money out of equities and into bonds, putting downward pressure on stock prices. Rising yields also increase borrowing costs for companies, squeezing profits and reducing valuations. Here's that relationship clearly mapped. Rising bond yields make bonds more attractive. Capital shifts away from stocks. And stock prices come under pressure. Understanding this link is essential for any student of financial markets. Let's wrap up. Bonds are loans to governments or corporations with fixed interest and a repayment date. Governments issue bonds to fund budget deficits when spending exceeds tax revenues. Institutional investors like pension funds and central banks are the main buyers. Yields are the effective return and they move inversely to price. Bonds trade in primary and secondary markets. And rising yields put pressure on stocks. Those are your foundations. The bond market underpins the entire global financial system. Once you understand how it works, so much else in economics and finance starts to click into place: interest rates, monetary policy, government debt sustainability, equity valuations. Keep studying, keep questioning, and you'll get there. Good luck.